Hey there, I'm Courtney Thornell. Let me just start by saying if you find this video helpful, please be sure to like it, and I would appreciate it if you would subscribe as well. Today, I want to talk about something that comes up a lot with FHA loans, Upfront Mortgage Insurance Premium, or UFMIP, and Mortgage Insurance Premium, MIP. These are two things you'll run into if you're looking at an FHA loan. Now, FHA loans are backed by the Federal Housing Administration. They're designed to help more people become homeowners because they offer lower down payment options and they have more flexible credit requirements. Sounds great, right? It is, but there's a catch. Because FHA loans are riskier for lenders, remember the lower down payments and more flexible credit, the government needs a way to protect lenders if borrowers default. And that's where you have the UFMIP and the MIP. These insurance premiums create a safety net for lenders, encouraging them to offer these loans to more people. It's insurance that protects the lender, not you. It's their way of reducing the risk since FHA loans are often easier to qualify for. Now, the first one I want to talk about is the Upfront Mortgage Insurance Premium, UFMIP. And as the name suggests, this is a one-time payment you make upfront at closing. The charge is usually 1.75% of the loan amount. The good news is you don't have to pay for it out of pocket unless you want to. But most people just roll it into the loan amount, and that's that. So, for example, if you're taking out a loan for $300,000, your UFMIP at 1.75% of the loan amount would be $5,250. That's a big chunk of money. But again, FHA gives you the option to roll the UFMIP into your loan so you can finance it instead of coming up with that cash up front. Now, this amount added to your loan does not affect your loan to value ratio. If you're putting 3.5% down and finance the UFMIP, your loan to ratio value is still 96.5%. Just keep in mind that financing it means your loan balance will be higher and you'll be paying interest on that amount over time. UFMIP is for all FHA loans, regardless of how much you are putting down. Now I want to switch over and talk about the mortgage insurance premium, MIP. MIP is also required on all FHA loans, no matter how much you put down. Even if you have 20% to put down, which would get you out of private mortgage insurance on a conventional loan, with FHA, you're still going to pay MIP. It's just part of the deal with FHA loans. So how does MIP work? It's a monthly fee added to your mortgage payment. This isn't a one-time thing like UFMIP. It is monthly and it sticks with your loan for a while. Now, if you can manage to put down 10% or more, you'll need to pay MIP for 11 years. If you're putting down less than 10%, MIP stays for the full loan term. Yes, that means 30 years unless you refinance out of it or if you move. So how much you pay for MIP depends on things like your loan amount, how much you put down in your credit. It's not a one-size-fits-all. So typically you'll see MIP added to your monthly mortgage payment. So it's not a payment you need to worry about making separately. You might be wondering, is this really worth it with all this insurance? Well, FHA loans do have some benefits that help balance things out. FHA loans often come with lower interest rates compared to conventional loans. So even with the added cost of UFMIP and MIP, that lower rate can help offset it. And you might end up paying less in interest over the life of the loan, which could make an FHA loan still a good option for you. It's one of the reasons FHA loans are so attractive for first-time home buyers or those who need a little bit more flexibility. Another thing to keep in mind is that FHA loans are a great option for people who don't have huge down payment saved up. And you can get an FHA loan with as little as 3.5% down, which is a huge help for borrowers who are looking to get started or looking to make their way into the housing industry. So make sure your loan officer, which I hope would be me, goes over options with you and outlines whether an FHA loan or a conventional loan would be better financially for you. They can break down the numbers and see what would be best for your home buying or refinancing situation. And if you have any questions, as always, please feel free to reach out. I'm happy to go over your options and help you find the best plan for your budget. And thank you so much for watching. I'll see you next week.